The ceasefire was supposed to reopen the world's most critical oil choke point. On April 9th, 5 ships crossed the Strait of Hormuz. Before the war, between 130 and 160 ships made that transit every single day. That gap is not a technicality. It is a signal that the ceasefire has changed the diplomatic calendar, but not the physical reality of global oil supply. Iran's deputy foreign minister confirmed Thursday that every vessel now requires army approval to pass, with crews directed around mines. The Abu Dhabi National Oil Company's chief executive put it plainly: the Strait of Hormuz is not open. Access is being restricted, conditioned, and controlled. Oil markets reached that same conclusion on their own. West Texas Intermediate climbed above $102 early Thursday, before settling near $97. That is still more than 70% above where crude traded before the war broke out in late February. The 16% drop that followed Trump's ceasefire announcement on Tuesday lasted less than 24 hours. Goldman Sachs published a note laying out the math. Under their base case, flows through the Strait begin recovering this weekend, and Persian Gulf exports return to pre-war levels within a month. Under that scenario, Brent averages $82 in the third quarter. But if the reopening is delayed by 1 month, Goldman sees Brent averaging above 100 through the second half of 2026. A longer closure with regional production losses pushes their forecast to $120 in Q3 and $115 in Q4. The downstream effects of sustained closure are already moving. Jet fuel disruptions are now described by IATA as comparable in severity to the aftermath of September 11. Global refining capacity has contracted 10 to 12% as operations in the conflict zone shut down. Even if the Strait fully reopens tomorrow, the IATA Director General said it will still take months to replenish jet fuel supply. Airlines have already absorbed roughly $400 million each in additional operating costs. United Airlines does not expect oil below $100 per barrel until 2027. Food supply is a quieter risk but a larger one. A third of internationally traded fertilizer moves through the Strait. Natural gas, which determines 70 to 90% of nitrogen fertilizer production costs, saw prices jump up to 70% as production fell 20%. China blocked phosphate exports, removing a quarter of global supply. U.S. fertilizer inventories as of mid-March were running at roughly 75% of normal. With corn and wheat in their critical early growth stages, a 10 to 15% reduction in nitrogen application can cut yields by up to 25%. Beef, poultry, and processed foods dependent on corn syrup will reflect those input costs by summer.
That inflation pressure is landing on an economy that was already weakening before the war started. On Thursday, the Commerce Department revised fourth-quarter GDP growth down to an annualized rate of 0.5%, below the prior estimate of 0.7% and well short of the 2 to 3% pace that characterized 2024. Consumer spending, which accounts for roughly two-thirds of U.S. economic activity, barely rose in February. Economists describe it as reflecting gloomy inflation sentiment rather than genuine demand. The Federal Reserve's preferred inflation gauge, PCE, came in at 3% in February, data that predates the war entirely. The Cleveland Fed's own estimates suggest inflation could reach 3.5% in April, which would be the highest reading since 2024. Friday's March CPI report is expected to show a 0.84% month-over-month increase, which would be the largest single-month jump in nearly 4 years. Cleveland Fed President Beth Hammack said Monday that a rate hike is possible if inflation remains persistently above target. Chicago Fed President Austin Goolsbee warned of a potential stagflationary outbreak, using that word explicitly. Minutes from the Fed's January meeting revealed that 19 officials on the rate-setting committee wanted the post-meeting statement to acknowledge the possibility of upward adjustments to rates. As of Thursday, futures markets assigned a 78% probability to zero cuts in 2026, and Goldman Sachs noted that market pricing for a rate hike has risen to roughly 45%, up from 12% before the war. Fed Chair Powell has so far held the line, saying in late March that policymakers are taking a wait-and-see approach. The logic is that oil shocks are inherently transitory if the conflict is resolved, and that hiking rates into a weakening economy would compound the damage. That calculus made sense when the war was expected to be brief. 6 weeks in, with the Hormuz reopening still unresolved, the window for patience is narrowing. The tension is structural. If the Fed holds rates, it risks embedding inflation expectations at a time when the 2-year Treasury yield is already trading above the effective Fed-funded tightening cycle. If the Fed hikes, it would do so into 0.5% GDP growth, with consumer spending already softening. Vanguard has published analysis suggesting that oil above $100 for 2 consecutive quarters could reduce GDP by 20 basis points and add 80 basis points to inflation. The current trajectory puts both conditions within range by the third quarter. Friday's March CPI print is the first hard data that incorporates war-era energy prices.
A reading close to the Cleveland Fed's 0.84% monthly estimate would almost certainly force a recalibration of the Fed's public stance, even if it does not immediately change policy.
Against that backdrop, the largest technology companies are making bets that treat the macro environment as noise. Amazon CEO Andy Jassy published his annual shareholder letter Thursday and disclosed that AWS artificial intelligence services are now generating more than $15 billion in annualized revenue, a figure that surprised analysts who had not expected that disclosure. Amazon's custom Trainium 3 AI chips began shipping last month and are already fully subscribed. A significant portion of Trainium 4 capacity, which will not ship for another 18 months, has already been reserved by large customers. Amazon's in-house Graviton CPU chip is sold out, with 2 large customers having requested to reserve all available capacity this year. Jassy confirmed Amazon will spend approximately $200 billion in capital expenditures in 2026, primarily on AI data centers. He framed the spending not as a wager but as a response to committed customer demand. Much of the 2026 capex is already backed by customer contracts, with monetization expected to flow in 2027 and 2028. Amazon shares rose more than 5% Thursday. The same dynamic played out in a different form with Meta and CoreWeave. Meta committed to an additional $21 billion in AI cloud capacity with CoreWeave through December 2032, on top of the $14.2 billion agreement signed in September 2025. That brings Meta's total committed spend with CoreWeave to $35.2 billion. Meta has separately guided for $115 to $135 billion in capital expenditure in 2026, having already spent $72 billion in 2025. CoreWeave's total revenue backlog now stands at $66.8 billion, representing 342% growth from the start of 2025. The company projects 2026 revenue of $12 to $13 billion, implying year-over-year growth of more than 130%, against AWS growth of 17% and Azure growth of 31%. The divergence between these corporate commitments and the macro environment is now the defining tension in markets. The S&P 500 is on track for its 7th consecutive advance, its longest winning streak since October, despite oil remaining elevated, inflation rising, GDP growth slowing, and a ceasefire that has not actually reopened the world's primary oil channel. The weight of evidence points toward continued pressure on both inflation and growth through the second quarter. That case only holds, however, if Hormuz traffic does not recover meaningfully in the next 2 weeks. The key variable is Friday's CPI report and whether the 0.84% monthly estimate proves accurate. A print at or above that level would make it very difficult for the Fed to maintain a neutral tone heading into its next meeting. The recovery scenario requires a genuine opening of the Strait, not 5 ships but movement toward the pre-war level of 130 to 160 transits per day, which would allow oil to ease toward the Goldman base case of $82 by the third quarter. That would give the Fed room to hold without hiking and allow AI-driven earnings growth to offset macro headwinds. The scenario that would prove the current calm wrong is a March CPI print about 3.5% combined with Hormuz traffic remaining effectively blocked through April. That combination would force the Fed's hand in a way that neither patience nor optimism can absorb.